A shopping mall looks like the ultimate real estate trophy. Glass towers of retail, food courts, and endless parking. To most people, it looks like pure passive income. Just collect rent from hundreds of stores every month. But that picture is almost completely wrong. Behind every mall is a brutal financial machine. One bad anchor tenant can bring down the whole property. One recession can empty half the storefronts overnight. Malls do not just rent space, they engineer foot traffic. And that engineering costs far more than most people realize. So today we break down the real economics of owning a mall. Not the fantasy version people imagine. The actual numbers, the actual risk, and the actual math. Because on paper, malls look like a print money machine. Hundreds of tenants paying rent every single month. Parking lots that create free customer flow all day. Anchor stores that guarantee crowds without any marketing cost. It feels like a business that runs on autopilot. That illusion is exactly why so many investors chase this dream. They see a mall and imagine a cash flow empire. They imagine owning the beating heart of a city's shopping. They imagine thousands of shoppers walking past their property daily. They imagine rent checks landing every single month like clockwork. They imagine a trophy asset that only grows in value. Banks love malls too because the asset feels tangible and solid. Unlike a startup, a mall is bricks, concrete, and land. It feels safer than stocks. Safer than crypto, safer than a business. This perception pulls in everyone from small investors to global funds. But almost none of them understand what actually sits behind that rent check. To understand that, you first need to understand the price of entry. Owning a mall does not start in the millions. It starts in the tens of millions. A small strip-style mall can start around $5 to $15 million. A mid-size regional mall often costs $50 to $150 million. A large super-regional mall can cross $300 million easily, and that number is just for buying the physical structure. Land acquisition alone can eat a massive share of that budget. In dense cities, land value can outprice the building itself. Then construction costs pile on, especially structural steel and concrete. Parking structures alone can cost tens of millions to build. Multi-level parking decks are some of the most expensive parts of a mall. Anchor stores demand custom-built spaces, tailored to their exact brand. That customization adds even more construction cost before opening day. Utilities, fire systems, elevators, and escalators add millions more. Permits, zoning approvals, and city negotiations can take years. Most buyers never build a mall from scratch. Instead, they buy an existing mall through direct acquisition. Even buying an existing mall requires massive upfront capital. Lenders usually require large down payments for retail real estate. That can mean putting down millions before earning a single rent payment. On top of the purchase price comes renovation capital. Old malls often need facade updates, new flooring, and modern lighting. Tenant improvement budgets are needed to attract new brands. Marketing budgets are required just to reposition the mall's image. This is why so few individuals ever own malls solo. Almost every mall today sits inside large real estate investment trusts. These rats pool money from thousands of investors. They spread risk across dozens of malls at once. A single mall is simply too risky for most private owners. This barrier alone filters out almost everyone but serious capital. Now here is where the real mechanics start. A mall does not really sell space, it sells foot traffic. Every tenant is renting access to guaranteed customer flow. That access is priced through several layers of rent. The first layer is base rent, a fixed monthly charge. The second layer is percentage rent, tied to tenant sales. If a store sells more, the mall earns more too. The third layer is common area maintenance, known as CAM fees. CAM fees cover cleaning, security, lighting, and shared repairs. Tenants pay their share of these operating costs monthly. The fourth layer is property tax pass-through to tenants. The fifth layer is insurance cost pass-through as well. This entire structure is called a triple net lease. It shifts most operating costs from owner to tenant. On paper, this looks incredibly favorable for the mall owner. But it only works if tenants are actually paying and staying. Anchor tenants, like big department stores, work differently. Anchors often pay far lower rent per square foot. Sometimes anchors even own their own building inside the mall. So why would a mall owner accept lower rent from anchors? Because anchors pull in the crowd that everyone else depends on. Small tenants pay premium rent because of that anchor traffic. In simple terms, anchors subsidize traffic, small stores subsidize profit. This is the hidden engine behind mall economics. Big stores create footfall. Small stores convert that footfall into rent. It is a carefully balanced ecosystem, not just a building full of shops. Break that balance and the entire income model can collapse. This is exactly why anchor tenants hold massive negotiating power. Many anchors sign co-tenancy clauses into their contracts. These clauses let smaller tenants exit if the anchor leaves. That means one anchor closure can trigger a chain reaction of exits. Now let's talk about how much money actually stays with the owner. Gross rental income from a healthy mall can look impressive on paper. A profitable regional mall might generate $20 to $60 million a year. But gross income and real profit are two very different numbers. Operating expenses quietly eat a large share of that income. Property taxes alone can consume a significant portion of revenue. Insurance premiums for large retail properties are extremely high. Utilities for lighting, heating, and cooling run constantly. Security staffing across a large property adds major monthly cost. Cleaning and maintenance crews are needed every single day. Elevators and escalators require constant safety servicing. Landscaping, parking lot repairs, and lighting replacement add up fast. Marketing events, seasonal decorations, and promotions also cost real money. Then comes one of the biggest hidden costs, vacancy. Empty stores generate zero rent, but still cost money to maintain. Every vacant unit is a monthly financial leak, not a pause. Finding new tenants takes months, sometimes even years. Leasing commissions must be paid to brokers who fill space. Tenant improvement allowances often subsidize a new store's build-out. That subsidy can run into hundreds of thousands of dollars per store. All of this happens before the new tenant even opens. Now factor in loan payments because most malls run on heavy debt. Interest rates directly affect how much profit actually survives. A rise in interest rates can quietly crush thin profit margins. Refinancing a mall loan can become a make-or-break event. If a mall's value drops, refinancing gets harder and costlier. Many mall owners are essentially managing debt, not just tenants. This is where the mall business quietly becomes a finance business. The retail stores are almost secondary to the debt structure behind them. Now let's talk about risk because this is where reality bites hardest. Retail habits change fast and malls change slowly. Online shopping has permanently shifted how people spend money. Many traditional retail categories have shrunk inside physical malls. Department stores, once reliable anchors, have closed at massive scale. When one major anchor shuts down, the mall's identity weakens. Shoppers begin visiting less because the anchor pull disappears. Smaller tenants notice sales dropping almost immediately. Some tenants use co-tenancy clauses to break their lease early. This creates a downward spiral that is difficult to reverse. Foot traffic drops, then rent income drops, then property value drops. Lower property value can trigger loan covenant violations. Lenders may demand extra capital injections to protect their loan. If owners can't cover that gap, foreclosure becomes a real threat. This is exactly how many so-called dead malls were born. A dead mall is not created overnight, it decays slowly. First a few stores close, then whole wings go quiet. Eventually security and maintenance costs outweigh remaining rental income. At that point, owners face a brutal decision. Keep pouring money in, or abandon the property entirely. Many mall owners underestimate how fast consumer behavior can shift. They assume location alone guarantees permanent demand, but location only guarantees traffic if the tenant mix stays relevant. Malls that fail to renovate quickly become outdated fast. Shoppers today expect entertainment, food, and experience, not just stores. Malls that stayed purely retail-focused have suffered the most. Malls that added restaurants, gyms, and entertainment have performed better. But that transformation itself requires enormous renovation capital. Many struggling owners simply do not have that capital available. Their debt load is already too heavy to take on more. This traps many mall owners in a slow financial decline. They can't afford renovation, so tenants keep leaving. As tenants leave, income drops, so renovation becomes even less possible. It becomes a cycle that is extremely hard to escape. Meanwhile, property taxes and debt payments do not pause for anyone. Some owners try discount leasing just to fill empty space. Discount leasing lowers rental income across the entire property. That can permanently damage the mall's long-term valuation. Other owners try converting empty anchor space into new formats. Some malls have been converted into offices, clinics, or storage. Some have even been converted into apartments or mixed-use developments. But redevelopment itself costs tens of millions of dollars. Not every owner can access that kind of capital. Not every location is even suitable for redevelopment. This is why so many aging malls sit half-empty for years. It's not always neglect, it's often financial paralysis. The owner is stuck between old debt and new investment needs. Meanwhile, the property continues to decay physically and financially. This is the part most outsiders never see. From the outside, it just looks like an empty building. From the inside, it's a slow-moving financial emergency. Even successful malls face constant tenant negotiation pressure. Large retailers know their bargaining power and use it aggressively. They can threaten to leave unless rent is reduced. Owners often have to choose between lower rent or empty space. Either option quietly reduces expected profit. Percentage rent income also fluctuates with the broader economy. During recessions, retail sales drop and percentage rent drops with them. This makes mall income far less stable than people assume. It is not steady, guaranteed income. It is cyclical income tied to consumer mood. Insurance costs have also risen sharply in recent years. Extreme weather events have made large properties riskier to insure. Higher insurance premiums quietly shrink net operating income. Security expenses have also grown due to safety concerns in public spaces. All of these rising costs squeeze margins from multiple directions. Meanwhile, competition from online retail continues to grow every year. Some categories like electronics and books have almost vanished from malls. Malls have had to lean harder into experiences that can't be replicated online. Movie theaters, food halls, and entertainment zones became survival tools. But building those experiences requires constant reinvestment, not one-time spending. So is owning a mall actually a good business? The honest answer is it depends entirely on execution. A well-located, well-managed mall with a strong tenant mix can be extremely profitable. It can generate stable cash flow for decades. It can appreciate significantly in value over time. But a poorly managed mall in a declining area can become a financial trap. The difference between the two is not luck. The difference is active management, constant reinvestment, and tenant curation. Owners who treat a mall as passive income almost always struggle. Owners who treat it as an active operating business tend to survive. This business rewards people who understand retail trends deeply. It rewards owners who renovate before decline starts, not after. It punishes owners who ignore shifting consumer behavior. It punishes owners who over-leverage with debt during good years. Size and location matter enormously in this business. A mall in a growing city behaves completely differently from one in a shrinking town. A mall anchored by strong entertainment options behaves differently from a pure retail mall. Business format matters just as much as location. Some owners now blend retail with healthcare, offices, and housing. That diversification reduces dependence on retail spending alone. In the end, a mall is not a simple rent-collecting machine. It's a living ecosystem of tenants, traffic, debt, and constant reinvestment. The rent check is just the visible surface. Underneath sits vacancy risk, anchor dependency, and market volatility. That gap between perception and reality is where most new investors get surprised. The mall business can still create real wealth today, but only for owners who treat it as an active, evolving operation, not as a passive trophy asset that runs on its own. Because behind every glowing mall entrance sits a spreadsheet of hard decisions. And that spreadsheet decides whether the mall becomes a fortune or a slow-moving loss.